Right now, more than 160 million retirement accounts are tethered to a market worth over $50 trillion, a scale you can trace through exchange filings and Federal Reserve balance sheet data. That number is not abstract. It is payroll deductions. It is pensions. It is the quiet promise that if you keep contributing month after month, the future will eventually arrive fully funded. Screens update in milliseconds. Statements arrive once a quarter. The system feels distant, technical, almost polite. That is exactly why it works. Because the most dangerous part of a financial collapse is not the day the charts break. It is the long calm before it, when everything still looks normal and the incentives quietly force ordinary money to stand still while professional money starts moving. Over the last 100 years, major crashes have been described as different events with different causes. The story changes, decade to decade. In 1929, it was speculation. In 1987, it was program trading. In 2000, it was dot-com fantasy. In 2008, it was subprime fraud. Different villains, different headlines, different vocabulary. The mechanism underneath is more consistent than people want to admit. There's a sequence that appears months, sometimes years before the collapse. A repeatable chain that shows up in credit data, in market structure, in institutional positioning, and in liquidity conditions. If you only look at the final spark, you miss the structure that made the spark matter. The public is trained to look for the spark. The system is built on you looking for the spark. Here's the paradox that sits at the center of this story. If the structure is so consistent that it can be mapped, why are outcomes still treated like accidents? Not in hindsight commentary, not in academic journals, in real time, in the way portfolios are marketed, in the way risk is explained, in the way the same sentence returns every cycle, delivered with sincere confidence. The fundamentals are strong. That sentence is not always a lie. Often, it is an expression of a deeper truth. People inside the system are not cartoon villains. They're rational actors, navigating incentives that reward short-term performance, punish caution, and make career survival depend on staying in the crowd until the crowd starts running. In a boom, the crowd is the strategy. And when the crowd becomes the strategy, the system becomes fragile. To understand why, you have to stop thinking of a crash as a singular event. A crash is the visible moment when a hidden structure loses support. The collapse is not created by panic. Panic is what happens when the support is already gone. That is why the early stages matter. They are the stages where the rules are quietly rewritten, where leverage gets embedded, where risk gets concentrated, where liquidity becomes an illusion, where sophisticated capital moves first because it can. This story has a face, but it is not a villain. It is an early architect of pattern recognition. In September 1929, Roger Babson stood in front of an audience that wanted reassurance and gave them something else. He warned that a crash was coming. It was not a poetic warning or a mystical hunch. It was a claim that the conditions were already in place. Newspapers mocked him. The room laughed. The era's most celebrated economist publicly dismissed him, arguing that stocks had reached a permanently high plateau. 47 days later, the market collapsed. The famous economist lost nearly everything. Babson profited and later helped build institutions that outlived the panic itself. That part of the story is always told as a morality tale about arrogance and humility, or optimism and pessimism. But the deeper point is structural. Babson did not predict a crash the way people predict storms by watching clouds. He studied pressures inside the system. He watched credit. He watched concentration. He watched institutional behavior. He watched liquidity. He watched what he described as trigger vulnerabilities, the small stress points that do not matter until everything else is already stretched tight. 5 factors, 5 stages. That framework is the backbone of this documentary, not because it is mystical, but because it is mechanical. Stage 1 is the credit explosion. Before the headlines, before the fear, there's always debt. Credit expands faster than the economy can absorb it. Borrowing turns into bidding. Bidding turns into price inflation. Price inflation turns into confidence. Confidence turns into more borrowing. A loop that feels like prosperity because it produces the same surface effects as prosperity. Rising accounts, rising home values, rising optimism. But the loop does not create resilience. It creates dependence. The second stage is the concentration trap. A market can be overpriced and still survive longer than anyone expects. It becomes dangerous when risk is centralized, when a small number of assets carry too much of the system's weight. Then a stumble is no longer contained. It becomes a gravitational event that pulls everything else off balance. The third stage is the quiet exit. This is where the system reveals its social design. Institutions do not ring bells as they reduce exposure. They do not announce that they are raising cash or buying protection. Often their public posture is calm because calm is part of their job, but their positioning changes, their risk changes, their liquidity changes, and the public does not see it until later, because the public is not positioned to see it. The fourth stage is the liquidity illusion. Markets appear liquid right up until the moment they are not. The difference between a decline and a collapse is liquidity. With liquidity, prices can slide. Without it, prices gap. Without it, small selling creates violent moves. Without it, feedback loops take over. This is the stage where tightening policies, whether intentional or incidental, begin to matter. It is also the stage where everything still looks normal, which is why it is the stage that fools the most people. The fifth stage is the trigger, not the cause, the timing device, the match that lights a room already filled with gas. People obsess over the match because it is visible, because it is dramatic, because it fits into a headline. But the match only matters because the earlier stages made the system fragile enough to ignite. That is the structure. Now, return to the present tense. Look at the scale of modern debt. Margin borrowing, securities-based lending, options exposure that controls vast positions with small deposits. Corporate debt, swollen beyond what earlier generations would have recognized as normal, often used not to build capacity, but to manipulate equity supply. Government debt, at levels that transform interest expense into a governing constraint. Each category has its own story. Together, they form a single environment. An environment where the system cannot tolerate a normal shock without extraordinary intervention. Look at modern market concentration. The largest stocks now dominate major indexes to a degree that turns diversification into a comforting word rather than a functional reality. Passive inflows amplify winners. Weighting rewards size. Size attracts more weighting. It is a machine that looks elegant in rising markets. It is also a machine that reverses. And look at liquidity. Interest rates rising at a pace rare in modern history. Balance sheet contraction pulling cash out of the financial system. Stress events that appear briefly, then get patched with emergency programs that restore calm without removing fragility. Calm returns. The structure remains. It is also a machine that reverses. The question is not whether markets will fall again. They always do. The question is whether you can learn to see the phases while the surface still looks stable. Because if this framework is correct, the most dangerous part of the cycle is not the panic. It is the peace that comes right before it. And the first stage begins where every collapse begins. Not with fear, not with greed, but with credit. Credit is the system's favorite sedative because it creates motion without requiring productivity. It can manufacture demand before income exists. It can pull tomorrow's purchasing power into today's prices. And for a while, it feels like everyone is winning. Businesses expand. Households spend. Governments promise. Asset owners watch numbers rise. The economy looks like it is accelerating, even when the real engine is just borrowing. In the earliest part of the sequence, the expansion rarely looks reckless. It looks innovative. It looks like inclusion. It looks like efficiency. That is the first trick of stage one. Credit does not announce itself as danger. It introduces itself as opportunity. In the late 1920s, the opportunity had a clean, simple name: margin. You could put down a small slice of cash and control a much larger position in stock. It felt like modernity. It felt like democratization. Ordinary households could participate in the wealth of the industrial age. The newspapers celebrated it. Brokerages marketed it. The market rewarded it. The mechanics were basic. Borrowing increased buying power. Increased buying power pushed prices higher. Higher prices created the impression of safety and skill. Safety and skill attracted more borrowers. The loop tightened. At a certain point, the market stopped being a place where ownership reflected the future earnings of companies. It became a place where ownership reflected the availability of loans. That is not a moral failure. It is a structural one. When leverage becomes common, price becomes a function of financing conditions. This is where Babson's method matters because it treated credit not as background, but as the first stage of the trap. When debt expands faster than the underlying economy, it creates a hidden fragility. The system becomes dependent on continued credit growth, not stable growth, continued growth. If credit merely slows, the momentum that held prices up begins to stall. If credit tightens, the loop reverses. In a leveraged system, reversal is never gentle. In 1929, when confidence cracked, margin calls turned selling into obligation. People did not sell because they changed their minds. They sold because the loans demanded it. Prices fell, collateral weakened, lenders demanded more collateral, and the forced selling cascaded. A credit boom does not end when people lose faith. It ends when the system runs out of balance sheet capacity to keep lending. The same logic returns in later decades, even when the instrument changes. In 2000, the surface story was technology. New companies, new networks, new metrics. But underneath, much of the machine was still credit. Corporate borrowing became a fuel source for expansion stories that did not yet have profits to justify them. Businesses raised money easily because prices were high, and prices stayed high because capital was easy. Then the price fell, collateral weakened. Financing became harder. The narrative shifted from inevitability to scrutiny, and the same structure appeared again. Companies built for growth at any cost discovered that credit is generous only while confidence is rising. In 2007, the surface story was housing. The instrument was the mortgage, but the mechanism was still the same. Credit expanded far beyond what household incomes could sustainably support. Loans were offered with minimal buffers, minimal verification, minimal protection against rate changes. Then those loans were repackaged. Risk was redistributed through securities. The public story said the system was diversified and resilient. The reality was that leverage had been embedded everywhere. The fragile part of this stage is not only that borrowers take on more than they can repay. The fragile part is that the system builds a chain of promises on top of those loans, and that chain becomes politically and financially difficult to unwind. Once mortgages are transformed into securities held by pension funds and institutions, a downturn stops being a localized problem. It becomes a broad balance sheet problem. A credit contraction does not just hit borrowers. It hits the holders of claims on borrowers. Then it hits the lenders to those holders. Then it hits the insurers of those lenders. At that point, a mortgage is no longer a mortgage. It is a node in a network. When the network is built on leverage, the network reacts to stress by demanding liquidity. This is why stage one matters more than the public story. You can argue about greed forever. You can argue about bubbles forever. But credit is measurable. It is the hard variable that turns optimism into fragility. Now, bring that lens to the present. The transcript points to official margin borrowing around the hundreds of billions, but also argues that this understates the real leverage in the system. The underlying claim is that modern leverage is more distributed and more hidden. Borrowing against portfolios expands effective buying power for wealthy investors. Options markets allow small amounts of capital to control large positions. Corporate borrowing grows and often returns to equity markets through buybacks rather than productive investment. Government borrowing grows to a scale where interest costs begin to compete with core budget priorities. The exact totals can be debated in detail, but the structural observation is the same. Debt is no longer a tool used during emergencies. It is a baseline operating condition. And that baseline creates a political reality. A system built on permanent credit expansion cannot easily accept higher interest rates, tighter financing, or slower asset price growth without pain. That pain does not distribute evenly. It concentrates where leverage is highest, where cash flow is thinnest, and where refinancing is necessary. This is why stage one feels like prosperity and behaves like a trap. Credit expansion is socially soothing because it postpones trade-offs. It allows households to consume more than income. It allows companies to grow beyond profits. It allows governments to promise beyond taxes. But postponing trade-offs does not remove them, it stacks them. And once enough trade-offs are stacked, the next stages become more likely, because an over-leveraged system cannot tolerate disorder. It needs stability. It needs confidence. It needs liquidity. It begins to reward assets that look safest and largest. It begins to centralize. That is how stage one naturally feeds stage two. Credit creates the rise. Concentration creates the fragility. Before we move into that next stage, pause on the emotional truth of this first one. Stage one is not dramatic. It is paperwork. It is loan documents. It is new products that make borrowing easier. It is a culture that calls leverage sophistication. It is a decade where the cost of money feels low enough that risk looks like a personality trait instead of a financial condition. It is also the stage where almost no one feels the need to prepare, because the system does not punish leverage during the build. It rewards it. It promotes it. It points to the rising prices as evidence that it is working. The policy worked. That was the problem. In stage two, the system does something that looks like diversification but behaves like dependence. It starts to lean on a smaller and smaller set of pillars, because in an over-leveraged environment, capital becomes allergic to uncertainty. Money does not spread out evenly across opportunity. It clusters around what feels inevitable. At first, concentration looks like wisdom. The largest companies are profitable. Their brands are everywhere. Their balance sheets look strong. Their executives speak in confident paragraphs. Analysts model their growth in clean lines. Index funds allocate more to them because they have grown larger, and they grow larger because index funds allocate more to them. The loot feels passive, automatic, almost harmless. But concentration is not about popularity. It is about load-bearing weight. A system can absorb the failure of a small company. It struggles to absorb the instability of a dominant one. And when dominance is shared among a handful of names, the market stops acting like a broad ecosystem and starts acting like a single organism with a few critical organs. Babson understood this in the language of his era. He watched the glamour stocks, the ones that drew public fascination, public money, and public confidence. In 1929, one of the most famous was Radio Corporation of America. Investors did not need to understand radio to buy it. They only needed to believe that radio was the future, and that belief became a substitute for valuation discipline. A chart that rises for long enough starts to feel like proof. The tragedy of concentration is that it becomes self-validating. Rising prices attract attention. Attention attracts flows. Flows push prices. Higher prices increase market weight. Higher market weight draws more passive buying. The biggest names become bigger not just because of their earnings, but because of the system's plumbing. In calm periods, that plumbing is invisible. It looks like growth. It looks like the economy is being led by winners. It looks like the market is rewarding excellence. Then one pillar stumbles. The danger is not that a large stock can fall. Large stocks fall all the time. The danger is that when the market is concentrated, a fall is no longer a local event. It becomes an index event, a retirement event, a confidence event. Selling does not stay contained because passive vehicles translate selling pressure into broad liquidation. What feels like a bet on the economy becomes, in practice, a bet on a narrow narrative. This is the part no one tells the public clearly because it sounds like an accusation, even when it is only math. If a small set of companies represent a large share of index value, then buying the index is buying those companies, with a thin layer of everything else sprinkled on top. That is not a judgment. It is allocation arithmetic. The transcript makes that arithmetic explicit for the modern era. A small group of top stocks in the largest index accounts for a towering share of total weight. That means the average saver, the person contributing through payroll, believes they are diversified across hundreds of businesses, but is structurally exposed to the performance and valuation of a handful. It is not that the other companies do not matter. It is that they matter less to the index outcome than most people assume. This is why concentration is a trap. It hides inside the language of safety. In 2000, the trap was visible to anyone willing to look. A few technology names carried enormous influence. The Nasdaq became a proxy for a narrow sector narrative. The story was that the internet rewrote the economy. The counter-story was that valuation still matters. The market chose the story it wanted. Then reality did what reality always does. It asked for cash flows. When those cash flows could not justify the prices, the adjustment did not distribute evenly. It concentrated. The largest names became the center of gravity for the collapse, and the collapse spread outward through funds, portfolios, and sentiment. In 2008, concentration looked different but behaved the same. It was not concentrated in a consumer brand or a software monopoly. It was concentrated in the financial system itself. A small number of institutions held extraordinary exposure to derivatives and structured products. The public did not understand how centralized that exposure had become. Even many professionals underestimated how interconnected the balance sheets were. When one major node failed, the fear was not about one bank. It was about the network. That is what concentration really means. It means the network has fewer shock absorbers. It means the system has fewer alternate routes. It means failure has fewer places to go except outward. Now bring the lens back to today, and the modern twist becomes clear. Concentration is no longer an accident created by stock pickers chasing fads. It is a byproduct of how capital is packaged. Indexing turns growth into weight. Weight turns into automatic buying. Automatic buying turns into more growth in weight. Then the process repeats until the market's top looks like a mountain range with a few peaks and a long flat valley below. In a rising market, this feels stable. Because the largest names are liquid, widely covered, and constantly bid by passive inflows, they become the default home for risk. But stability created by flow is not the same as stability created by fundamentals. Flow can reverse. When money leaves index funds, it does not leave evenly. It leaves according to weight. The largest positions generate the largest sales. Those sales can push prices down. Lower prices reduce market value. Lower market value can trigger more de-risking. The same mechanism that accelerates the climb can accelerate the fall. This is why stage 2 is not merely a description of market leadership. It is a description of systemic fragility. And the deeper the concentration, the more perfection is priced in. When a handful of companies carry the market, their valuations often begin to assume flawless execution. Not good results, continuous results. Results that leave no room for disappointment, regulation, competition, demand shifts, or margin pressure. A concentrated system does not require a catastrophe to wobble. It only requires the narrative to lose its inevitability. That is why this stage has a particular psychological texture. People do not feel exposed. They feel protected. They are holding the biggest names, the most admired names, the companies that seem too essential to fail. In past cycles, investors said similar things about the most dominant industrial firms, or the most beloved consumer franchises, or the banks that sat closest to the state. Essential does not mean immune. Essential can mean systemic. And systemic means that when stress arrives, policymakers, institutions, and markets all face the same claustrophobic constraint. Let the pillar fall, and you risk pulling the index with it. Support the pillar, and you reinforce the concentration that created the fragility. This is how incentives lock in, not through conspiracy, through rational choices under pressure. Stage 2 ends with a quiet realization that feels almost impolite to say out loud. A market can survive exuberance. It cannot survive imbalance. Stage 3 begins when the crowd still feels confident, prices may be stable, headlines may still celebrate resilience, analysts may still talk about new highs, strong earnings, and innovation cycles. This is what makes the third stage so corrosive. It happens under the cover of normality, and it reveals a social asymmetry that is built into modern markets. The public sees price, institutions see positioning. In every major crash, there's a period where sophisticated capital quietly reduces exposure while encouraging ordinary capital to remain patient. This is not always a coordinated act. It does not require a central room or a single plan. It is the natural outcome of incentives. Professionals are paid to manage downside. They have tools to hedge. They have access to real-time order flow and deeper liquidity. They have the ability to raise cash without changing their public posture. Most households do not. So stage 3 looks like a slow shift in who is holding the risk. The market becomes a transfer mechanism, not through evil, through structure. The people closest to the exits are simply the first to notice that the building is filling with smoke. The historical examples in the transcript are not presented as mythology. They are presented as the logic of money management under uncertainty. In 1929, powerful financial families and major operators began reducing exposure months before the crash. The details differ depending on which archive you read, but the pattern is consistent. Large holders de-risked into strength. Public confidence remained. Ordinary buyers continued to enter, often using leverage, because the rising market itself felt like confirmation that created what the transcript describes as exit liquidity. It is a cold phrase, but it is accurate. When a large holder sells, someone must buy. In 2007, the institutional shift happened even earlier. Some hedge funds began positioning against subprime risk long before the public understood the fragility of mortgage finance. The most controversial version of this pattern is when institutions sold securities while also building protection against those same securities. That behavior can be framed as a conflict of interest. It can also be framed as the logic of an intermediary trying to survive in a system where demand for yield is relentless, and the penalty for stepping away is lost market share. Either way, the consequence is the same. Risk migrates outward. Stage 3 is when the narrative begins to split. Private positioning becomes cautious. Public messaging remains reassuring, and the gap between those two becomes a measure of how close the system is to its inflection point. This is why the transcript emphasizes insider behavior. Corporate insiders are not omniscient. They cannot time macro cycles perfectly, but they do have something the public does not. They have visibility into their own balance sheets, their own demand trends, their own margin pressures, and their own financing needs. When insiders sell at unusual rates while retail flows increase, it does not guarantee a crash. It does something more important. It signals that the people with the most granular information are choosing liquidity over exposure, and liquidity preference is contagious. There is a deeper structural reason this stage appears so consistently. In modern markets, the public is encouraged to behave like a long-term institution without being given the institutional tool set. Households are told that discipline means staying invested. They are told that timing is impossible. They are told that downturns are temporary. Much of that advice is defensible over long horizons, but it becomes dangerous in a system where concentration and leverage have already turned the market into a brittle machine. Because by the time the public realizes the environment has changed, the exits are narrower. Stage 3 is the moment when those exits start to matter. A professional can sell in increments. A professional can hedge with options. A professional can rotate into cash like instruments. A professional can borrow against assets if they need liquidity or deleverage before volatility spikes. Most households cannot do these things easily, and many do not know when they should. So stage 3 is not just about selling. It is about information asymmetry expressed through behavior, and that behavior becomes part of the mechanism. As smart money reduces exposure, price can still rise because passive inflows keep buying, because buybacks keep supporting, because narratives remain intact. The system can look healthier even as its foundations hollow out. That is why this stage feels infuriating when you finally see it clearly. The rules do not change publicly, they change quietly in portfolios. Stage 3 ends when the transfer is far enough along that a new problem emerges. Liquidity begins to matter more than valuation. Not because people suddenly become irrational, but because the system's earlier stages have made it dependent on constant bid support. That is where stage 4 arrives. The liquidity illusion is the most deceptive phase because it offers the public a false signal. If prices remain high while central banks tighten, people conclude that tightening does not matter. If volatility stays low, people conclude that risk is contained. If headlines move on, people conclude that the stress has passed. But liquidity is not the same as price. Liquidity is the ability to transact without moving the market. It is the depth beneath the quote. It is the confidence that someone will be on the other side when you need them. When liquidity is abundant, shocks get absorbed. When liquidity is thin, the market does not fall smoothly. It breaks in steps. It gaps. It cascades. In 1928 and 1929, tightening policies drained the conditions that supported speculative prices. The market did not collapse immediately. It kept rising long enough to convince people that the tightening was harmless. Then, when selling pressure finally appeared, bids vanished, not metaphorically, functionally. The market did not glide down. It dropped because the structure that would normally cushion selling had been quietly removed. In 2007 and 2008, the same pattern returned through a modern plumbing system. Rates rose, credit conditions tightened, yet prices held for longer than expected. This delayed collapse trained people to believe the system could handle it. Then, one institution failed, and suddenly everyone discovered what had been true for months. Liquidity was not a permanent feature. It was a temporary condition. Now place that same logic into the present day, as the transcript does. Rapid rate increases, balance sheet reduction, quantitative tightening pulling cash out of the system, markets that appear calm anyway. The surface says resilience, the structure says dependence. Then March 2023 arrives as a preview of what liquidity stress looks like in a world built on duration risk and confidence. Multiple banks fail in rapid succession, not because every loan suddenly defaulted, but because rising rates changed the value of assets and the behavior of depositors. The failure mode looked like a surprise to the public because it happened quickly. It was not a surprise to the mechanism. Once confidence in funding disappears, liquidity becomes a cliff. Emergency programs can stabilize the moment. They can provide time. They can restore the appearance of calm. But calm is not the same as repair. A patched system can still be fragile. Sometimes, the patch itself becomes proof of fragility because it teaches markets that the state will intervene only when breakage is visible, and stage 4 is defined by what is not yet visible. This is the moment where the oxygen begins to thin while the room still looks bright. And when the oxygen thins enough, the only thing left is stage 5, the trigger. The trigger is never the story, it is the timestamp. By the time stage 5 arrives, the crash is already built into the structure. Stage 1 loaded the system with debt that cannot be serviced without continued growth. Stage 2 concentrated that risk into a small set of load-bearing assets and institutions. Stage 3 shifted exposure away from those with flexibility and toward those with the least. Stage 4 drained the liquidity that would normally soften a shock. At that point, the system does not need a large event to fail. It needs an event that arrives at the wrong angle. In 1929, the spark could be framed as a scandal, an arrest, a headline that looked irrelevant to American prosperity. The details mattered less than the timing. Overseas exposure required cash. Cash required selling. Selling met a market with thin bids. The sequence did the rest. The Great Depression did not begin because one fraud case was historically important. It began because the system had become so tight that almost anything could have pulled the thread. In 2008, the spark carried a name people remember because it was large enough to make the story legible: Lehman. But the same logic applies. If the structure is saturated with leverage, concentrated exposures, and fragile funding, the exact spark is interchangeable. The system is waiting for a reason. That is why stage 5 cannot be predicted cleanly. Predictions imply a single cause. Triggers are usually ordinary events that become extraordinary because the environment has changed. A geopolitical miscalculation, a sovereign credit scare, a derivatives loss that forces a major counterparty into fire sales, a commercial real estate refinancing wave that breaks a lender, a political standoff that shakes confidence in payments, something that would have been absorbed in a healthier market and becomes catastrophic in a brittle one. The transcript makes a specific claim about timing, that when the first 4 stages are clearly active, the trigger often arrives within roughly 12 to 24 months. That is not a promise, it is a pattern the script is examining. Markets can stay elevated longer than logic suggests, especially when narratives are strong and interventions remain available. But the structural point remains. The longer the system stays stretched, the more sensitive it becomes to the smallest disturbance. There is no clean escape from this architecture. If you try to remove leverage quickly, you risk breaking the economy. If you try to preserve asset prices indefinitely, you deepen the dependence. That is why reform is resisted, even by people who understand the danger. Not because they are villains, because the system punishes anyone who moves first. So the cognitive upgrade is not a forecast. It is a lens. Stop asking what will cause the next crash. Start watching what makes the system unable to absorb a shock. Credit that expands faster than reality. Concentration that turns indexes into a narrow bet. Quiet institutional de-risking that shifts risk outward. Liquidity that looks abundant until it suddenly is not. Then the trigger arrives, and everyone argues about the spark, because it is easier than admitting the room was already filled with gas. Once you see this sequence, you stop seeing crashes as surprises. You start seeing them as the system behaving as designed.